Today, we're talking all about a very important thing that can mess up your deal to buy or sell your small business. We're talking about things that can come up with the landlord. Stay tuned.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium sized businesses while controlling risk. So, if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So, be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win.
Hey everyone, I wanted to create this video all about landlord issues because I realized I haven't made a video specifically about this topic before. And it's one of the things that comes up that can really delay or derail a deal. And from the perspective of business sellers, it's a place where value can be lost in your business. That has absolutely nothing to do with you, your business, or the buyer. It's an outside factor that can really influence deals. And so I wanted to cover these topics here today. And so the very first thing that we have to determine if we're going to be considering how a landlord may, play into uh, frustrating a deal, let's say, is we need to understand, is number one, is there a landlord, or is it the business owner who owns the property, right? So, business owners who own the real estate, you got a choice. You can either sell the business and the building together, which means that you need a buyer that has a lot more money available as a down payment because they've got to make a down payment on the business and a down payment on the building, right? So this is a bigger initial check that has to be written, more financing, etc. Um, I always have coached business sellers to be open to the idea of becoming the landlord for the buyer, and the reason for this is simply because once you separate the two and you're now just trying to sell the business, first of all, the buyer does not have to be a person with as much cash to make the deal on the business only. And the building can then become a passive income source for you. You can collect rent for a couple of years. And nine times out of 10, the buyer of the business will eventually want to buy the building. And so they'll then make a deal with you later, probably after they have 2 or 3 years of financial statements of their own from running the business. And at that time, they're not going to have any trouble getting a mortgage from a bank because they'll be able to demonstrate that they can adequately run the business. And maybe the amount that they're paying to you in rent will be approximately what they would pay in mortgage payments. And they'll be able to make a really great argument to a lender as to why they should qualify for a mortgage. And then you can sell the building. But here's the thing, not only did you sell the business and then sell the building, but you also collected the rent in the interim. So it can really be positive for business sellers. If you do not own the building, if you own a business that's in a leased location, the next thing we have to consider is, and this is important for buyers, is the location strategically important? If the location is strategically important, then the lease and the ability to for the buyer to get their hands on the lease is going to be a critical part of this whole factor. So let me share my screen. I want to show you guys something. This is called the Locus of Goodwill calculator. And so this is a tool that is contained in one of our consulting services called Buyer Insight Analysis version 4. And so if you head over to businessbuyeradvantage.com, that's where I have all of my different services listed for people that want to buy a business. The online training is on there, the group coaching program, etc. At the very bottom of the page, there's a section on buyer insight analyses, and there's a video there. It's 10 or 12 minutes long. It goes into the different services. There's two versions of the buyer insight analysis. And this tool, the Locus of Goodwill tool, is included in version 4. So how does this work? Basically, there's a series of questions here that are answered yes or no. And then there's a points value, and then the points are distributed between the different places where goodwill can reside in the business. So, goodwill is an accounting term. It's basically the difference between the price someone's willing to pay for a business and the value of the tangible assets within the business, inventory, operating capitals, machinery, equipment, trucks, etc. And so then so that's the accounting definition. But why are people choosing to do business with this firm, right? And there's basically three primary places where that can generate the reasons. It's either that people know and trust the owner of the business, in which case we're talking about goodwill residing with the owner. And this is the most dangerous kind of goodwill for buyers because uh, are the customers going to like you as the new owner, right? The second place where goodwill can reside is within the brand of the company. So, Coca-Cola, like I don't know who the president of Coca-Cola is or the chairman, and I don't care, right? Like the product stands on its own. I recognize the branding. I see it in the grocery store. If I'd like to have some of that, I'll buy it. It represents something, right? But all of that goodwill of that brand is represented in the trademarks, logo, the name of the company. In the world of small business, a corner store gas station that has, an Exxon sign on it, that might be an independent local business for someone, but everyone's just going to look at it and say Exxon, right? So in that case, the goodwill resides in that name. So and then the third place where it could reside is simply in the location. So you could have a certain kind of store in a certain location, and people just know that there's a store of that kind at that location. So if you are a highway side truck stop, for example, it may not matter who owns it or what the name of it is, but if there's a 50-mile stretch with no place to stop and get gas, then there's a real reason why people are doing business with that business because of where it's situated. And for example, I've told the story before about a used furniture store where there has been multiple different businesses in the same location, and if that business ever closed and you rented that spot and opened a used furniture store, you would get clientele just because people who maybe bought furniture 5 years ago, and they knew that there was a used furniture store there, might just go there and show up because they want to buy some used furniture, and that's where they've always gone. So goodwill can reside in the location. And this is really important in certain kinds of retail trades or restaurants or things like this, where everyone's always gone to the same place for a certain product or service, and they know that location. So in this example here, the what I did is I filled it out using an auto repair business that I kind of had in mind. I went through and I answered all the questions, yes or no, and it generated this. And the gray section here represents goodwill in the business or brand. The orange section here represents the weighting of the goodwill that was identified within the owner, and the blue section here represents goodwill relating to the location. And as you can see, it's about 3/8 or about 37% of the goodwill is associated with the location. So down here in the bottom, there's a couple of messages here. Then these are messages for buyers. It says the business seems well positioned to allow a new owner to take over with minimal impact on the market's perception of the company because most of the space is gray. So the customers are used to doing business with employees in the location. They have very little interaction with the actual owner. The owner isn't part of the branding. It's not, David's auto repair or anything like that. And so it's well positioned for takeover of some by somebody else. But it also says here the location of the business plays an important role in the business success. A long-term lease or purchase of the real estate or option to purchase should be a priority in your offer and deal. And so this tool kind of measures that. You know, I was tired of spitballing what I thought, how I felt, or analyzing certain factors every time I was talking with a buyer about where I thought, the importance of this was. So I created this tool. And so this is available to customers who buy that consulting service, or you can kind of build your own tool using this kind of thought process, right? So what sort of things are important for a business that relies on its location? Now, let's let's get back to the deal making. So, discussions with the landlord or talking about the lease should be something that happens earlier rather than later in the deal making process. The very first thing you want to determine is what kind of landlord are we dealing with? There are two kinds. There are sort of the mom and pop real estate investors who, are individual people. And when you deal or negotiate the lease with one of these businesses, you're actually probably going to talk to the person that owns the building or the president of the company, and they're the only shareholder kind of thing. The other kind of landlord that you might have would be the big institutional landlord. So this is a real estate investment trust or a big corporation of some kind, and they're going to be bureaucratically driven. So they're going to have processes and procedures, and they may or may not be easy to navigate. And there may or may not be reasons why they will allow certain kinds of things to happen in your deal. So a lot of the times, business sellers, they don't really consider the impact that the landlord or the lease is going to have on their deal. They kind of just assume that because they've been in a given location for maybe 20 years and they've always gotten along well with the landlord or the property manager, that it's just going to kind of be an easy thing to hand this over to the buyer. But that may not necessarily be the case. And there's going to be a lot of different ways that landlords can frustrate the deal making process. And I'm going to get into those here as we move on. So, for example, um, buyers could face an increase in rent. They could, and if you do as a buyer and you're talking with a landlord who wants to raise the rent, what you have to do is you have to go back and re-normalize the financial statements of the business. Here's why it's important. When we do a normalization of the cash flow to determine what the SDE or the EBITDA is of the business, we're using the historical numbers of that business. If we then and we're basing our offer based on this cash flow we perceive that's going to be available. If the landlord tells us, I'm going to raise your rent by $10,000 a year, what we need to do then is we need to go back into our normalized statements and increase the rent by the same amount in the past years to see what this new normal level of cash flow will be. Obviously, what that's going to do is lower the value that we're able to pay for the business. Because if we have to pay $10,000 more in rent and we're effectively offering, let's say, 2.5 times SDE to buy the business, well, the business's value just dropped by $25,000. Okay. And so for sellers, this is part of what you need to understand is that nothing changed in your business, but its value just dropped because the landlord is going to make the buyer pay more, which means that the buyer isn't going to have as much cash flow available to service debt, pay you, etc. Okay. And this is how landlords frustrate deals because what will happen is a buyer and seller will make a deal typically, and then you'll get into due diligence. And so in that due diligence period, that's when the buyer is typically going to start having those conversations with landlords. And they're only going to find out during that due diligence period that this adjustment in rent is going to occur. And they've already made an offer to you. Now they're going to have to, as they go through due diligence, go back and amend their offer to you, right? And it's going to feel bad, but I don't know what else there is to do. Like the business that you are selling is not the business the buyer is going to get because the landlord's changing the numbers. And that's not your fault. It's the landlord's fault, but it means that the buyer can't afford to pay as much. Landlords, on their part, will often try to delay conversations until a deal is serious. I've seen this many times. So, due diligence begins. Maybe there's a certain period of time for due diligence on the buyer's part, and the buyer will reach out to the landlord or ask for an introduction through the seller. And the landlord will say, well, finish your other due diligence and then we'll come and talk when you know you're serious and you want to buy this business. And what they're doing is they're letting you invest your time into the deal and they're letting you invest maybe expenses with accountants and attorneys to examine the business, and you're becoming more and more invested in the process. And so then you get into this sort of sunk cost fallacy scenario where you've now invested so much time and effort in the deal that you feel committed and you feel like you now need to get the deal done in order to justify all of the investment you've made in time and effort in the deal making process. And that gives the landlord greater leverage, right? And so what kinds of things are they going to then demand, right? They're going to ask for things like higher rent, but they could also ask for fees to assign the current lease. They could ask for, high deposits, higher than what the current seller of the business has for themselves. They could ask for all kinds of different things, right? And they know that if the location of the business is important to you, that they have a certain degree of leverage. And now that they've let you invest your other time and effort and expenses in examining the business, they know that you've got this now commitment investment that you've sunk into it. So this is why you need to have the conversation as early in the process as possible. And sellers, if you're able, open the conversation before you even meet a buyer. Talk to your landlord about the fact that you've decided to sell your business and prepare them and ask them what are the different things that you're going to be asking for. Are you going to be looking for an assignment fee? Are you going to be looking for a different kind of deposit than I have, etc. Okay. So landlords will sometimes also take some of the other aspects of the current deal or the current lease that's in place, and they will use them to improve their own standing or security position, right? They have the power to do this, so why wouldn't they? So I'll give you an example. You could have a scenario where there's 4 years left in a current lease, and maybe the current lease has options to renew. Okay. And so the landlord might say, "Oh, you're selling the business? Great. We will happily assign the lease to the new buyer, and we will require them to put a personal guarantee on this lease, and we will not release the personal guarantee of the seller." So now they've got two different people who have a personal guarantee on the lease, which of course further secures the position of the landlord, and they love that. Why wouldn't you want to do that, right? As a seller, this could upset you, and you may not like to do that. Most sellers have this idea that they want to uh, sell the business and break clear, like break free, and kind of move on. And there's a couple of different ways people get hung up in the transaction. They're not able to have this clean break. And the first one is one we talk about all the time on this channel, which is the seller's note. Okay. And so if a landlord is requiring your guarantee to remain on the lease and you're doing a seller's note, it could be a good thing. And here's why. Because if you do a seller's note and the buyer defaults on the note, what is your recourse? You could repossess the business, right? But if the buyer of the business has a completely new lease for the business and you then try to repossess the business and come back in, the landlord could then make you negotiate another new lease with them all over, in which they could ask for a higher rent and all this other kind of stuff, right? But if your name is still on the lease as a guarantor and you have to repossess the business, then you're still tied to that lease, right? And so you could have an easier time coming back in and taking over that leased location. And of course, the specifics of this conversation need to be had with your attorney because you need to look at the specific language in the lease, the specific language of the assignment, and ask the question to your attorney. Say, hey, if the buyer defaults on the seller note and I need to take this business back, does this scenario with the lease allow me to just step right back in and start paying the landlord again? Will I have this option? Of course, under a defaulted seller note, it's totally up to you what you want to do, if you want to try to repossess the business or not. And a lot of the times it really depends on how much the balance on the note is. If there's only 10 grand left, a lot of sellers just walk away from the scenario. But if it's a significant material amount of money, then you may want to have a plan for what could happen if you do need to take the business back. And if it's a leased location, you need to make sure that there's some kind of pathway to easily allow you to take the space back and get back into that relationship with the landlord. So um, let's talk about lenders. So when a buyer is buying a business, they're often getting a loan, and the bank is going to have a certain term to that loan. So it could be a 5 year, 7 year, 10-year term. If the business is in a leased location, the bank is going to want to ensure that the lease at least matches the term of the loan because they need to know that the business has a place to live and make money so that they can make the loan payments. So if the lender, the bank, says to a buyer, "We will do a 7 year business acquisition loan for you," and then the buyer can only negotiate for a 5 year lease of the location, I've seen lenders say, "Oh, well, in that case, we're only gonna amortize this loan over 5 years." And what does that mean? It means that the payments are gonna be higher. So if the landlord will not do a long enough lease, for the buyer, it means that the buyer's cash flow will be further constrained. So what element then has to be pushed upon. It's the terms of the deal with the seller. So what does that then mean? Does that then mean that the buyer can only afford to pay less for the business? It could. Or it could mean that the seller needs to have a larger seller note maybe put on standby for several years, and that note may only be paid if the buyer can then secure a renewal of the lease or move the business someplace, right? And so, again, it's another instance of how the landlord can create terms and conditions that can affect the buyer and in turn affect the amount of money that the business is worth or the terms under which the business can be purchased. So, again, for sellers, the landlord stuff is really important to understand and get your head around. And it's really important to be empathetic with the buyer that if the landlord is not being super cooperative and providing what the buyer needs, it will have an impact on you and what you're going to be able to get for your business. Um, Landlords can ask for larger deposits, prepayments, higher rents, excessive assignment fees. I mentioned that. Landlords can also be inflexible. They can deny based on new tenant criteria. So I had a client in California that recently bumped into this, where he was buying a business in a leased location. The business had been around for decades, well established, great cash flow. The buyer started talking with the landlord. The landlord said, "Oh, you want to rent this space? Fill in this new tenant application." So the buyer had to fill in all this net worth information about himself and et cetera, et cetera. And the landlord initially denied him, saying, "Oh, you don't have sufficient net worth or capital to rent from us." And who was he dealing with? Well, it was a large institutional landlord, a REIT, and they had a local property manager. And the person who initiates the lease process was an administrative person in an office, a young person who didn't really understand that what was happening was the same business that had been there for 20 years was continuing to be there. So he had to go in there and say, "Look, maybe my net worth isn't sufficient for you to lease me a new location for a startup business, but I'm buying this existing business and it's the business that's paying the rent, not me." Right. And he had to go in there and actually move it up a couple layers of management. But eventually he was able to make the case with the landlord that they should not just base their decision on looking at his personal net worth. And that's the kind of bureaucratic process that you may have to get entangled with some of these larger landlord outfits, because the people you're dealing with just may not be that business savvy, right? They're running a property, they're making sure the lawn's cut, the garbage is removed, they're collecting the rent on time. Um, but a lot of these businesses that have been around for a long, long time, they don't change hands very often. And so the whole idea of a business being purchased may be kind of new to the landlord, and they may not have proper internal processes to manage this kind of handover and properly analyze whether or not it makes sense to lease to the new person. Um, can you get an assignment of the current lease? Or do you have an opportunity to get a new lease? So, I have had situations before where people have wanted to buy a business, and maybe there's 2 or 3 years left on the lease, and the landlord is one of these small mom and pop operators, and the buyer meets with the landlord and says, "Hey, I'd much rather just have my own new lease. Can you write me a brand new 10-year lease and just kinda, like, tear up the old one?" And the landlords are like, "Yeah, that sounds great," because to that landlord, they think, "I'd rather hold a 10-year lease than a lease that only has 3 years on it," right? And then you get into some of these larger institutional landlords who say no. And you're like, "Why? Why would they say no?" Well, we don't know what has happened on the back end of that company. Like, what happens with these large companies is they'll sign these leases and then they'll take the leases, and those leases will be like collateralized or hypothecated or tied up in some other legal process, which often has to do with the financing for the commercial real estate. And so to get rid of that lease and put a new lease in place could open a can of worms that they just don't want to open. Okay. And so what I have seen people successfully do is I've seen people successfully get leases signed that start at the end of the current lease. So they'll get an assignment of the last 3 years, and then they'll have a new lease that starts from the end of that lease going onward. So again, and That's was necessary in order to help with the lender because the lender wanted to know that there was a proper amount of time left for paying the bank loan. Um, so the lease negotiations. Um, what can it look like? Well, the landlord often knows that they are ultimately in control of everything. And so with that knowledge, they sometimes, I mentioned before, they'll delay the negotiation as a trick to get you further invested in the deal. The other thing is that they will completely ignore or not respect any of the deadlines or timelines that you've tried to establish for your deal. So you could have a letter of intent or an offer on the business with a certain set closing date and a certain due diligence period, and then you could, agree on that with the seller. You get into due diligence, you start to examine everything, you say everything's great, you're talking with your lawyer, you're talking with the lender, everybody approves everything. The landlord just keeps delaying stuff. The landlord takes their own time, they set their own agenda. And then you're sitting there with a completed purchase and sale agreement, a lender that wants to close before the end of the quarter, because they want to get it in their books in a certain period. And the landlord's just taking their sweet time. And like there's not really much you can do. Uh, they ultimately are the ones that own the building, and they already have a lease in place, which requires the current owner to pay them every month. So there's really no motivating factors at all sometimes that are pushing the landlord to act quickly on your timetable. And what is weird to me is a lot of the times business sellers will get frustrated with buyers because they haven't closed on the deal. They're like, "Hey, I want to close on this deal. You said it was going to be January 31st, and we're still talking about this here. It's now the second week of March. If you can't, get your act together and get the money together in my hand, I'm going to pull out of this deal." And meanwhile, it's got nothing to do with the buyer. The financing is lined up, the due diligence is done, the legal paperwork is all prepared, and the landlord is dragging their feet. And so, again, if you are a business seller in a leased location, uh, be aware that these conditions can exist and these situations are real, and it will frustrate your deal. And it will, if you are in that scenario I just described, um, don't walk away from the deal because all that's going to happen is the next person you bring into the deal is going to have exactly the same frustrations, and it's just going to create delays and confusion again. Um, what is the cost of moving? So if it's not a location dependent business, then part of your analysis as a buyer is probably maybe should include an estimate of what it might cost to move the business. Um, so that when you're talking with the landlord, you kind of have this idea in the back of your head that if the landlord's being really unreasonable or expecting really big increases in rent, and there's another place maybe that's cheaper, and you kind of know what it would cost to move the business, that you have this as a plan B. Um, Another thing that can frustrate people with respect to financing and landlords is claims of ownership. So in SBA financing, we look at the value of the business. This is for Americans. For people that are doing conventional financing, where the assets of the business are the collateral for the loan for the buyer, or people that are in other countries like Canada, they're going to be looking at the collateral as the basis of what can be borrowed at the bank. So you could have, for example, a business owner that installed signage. Maybe they installed counters in the business. Maybe they installed a big compressor that is like fixed to the real estate. And in their mind, this is their property. The lease, though, probably has language in it saying that if there's ever been a default or at the end of the lease, any things that have been attached to the property become the landlord's property. Okay. And so what I've seen happen sometimes is that the buyer will have this list of equipment from the seller of things that are in the business. They'll use that. Maybe they'll even get an appraisal and they'll use that to get a loan from a bank. And the bank now understands that the lease is going to have this clause saying that for non-payment of rent, the landlord gets to lock the doors and all the assets of the business become theirs for non-payment of rent. The bank, though, wants their collateral to be protected. So the bank will send a document to the closing table for the landlord to sign saying that they understand that all this stuff is bank collateral. And if you are going to lock the doors of this business and kick out these tenants, we have to be informed and we have to be given time to come and take our collateral. And they'll have on there the stuff. and it'll say the compressor, the leasehold fixtures, the signage, etc. And the landlord will say no, because when we terminate the current owner's lease, that stuff becomes ours. So there can be a problem with claims of ownership on certain assets in lease locations. And this is one of the reasons why you want to have this conversation as early as possible. So if you are a business owner and you're talking with your landlord and saying, I'm going to sell the business, make sure you understand the language in your lease and make sure that you talk with them up front and say, I just want to be clear. These things that I've paid money for, these are my property, and a buyer is likely going to be using them as collateral in the purchase of the business, and I need to make sure that it's going to be okay with you, that you're going to sign some kind of I think it's called an abeyance or something like that, for the lender, saying that you understand that these items are going to be collateral for them, not for you, right? Again, all of this stuff, as early as you can deal with it, the better it's going to be. Um, Landlords, on the positive note, can also be a source of off balance sheet financing for buyers. So if the business is a little tired and long in the tooth and needs a bit of a makeover, when you're talking with the landlord, you might be able to negotiate to have some money given to you to fix things up, and you might be able to trade that for a bit of a higher lease payment. This is very common when buildings are new or spaces are vacant, and landlords are trying to incentivize people to take those spaces. Well, the negotiation when you're buying a business is to get a longer term. Say, hey, my banker wants me to have at least a 10-year term because of the loan. But if you want to advance me some money to do like these painting updates, new signage, etc., then I'd be happy to sign a 12 or 15-year lease, maybe at a slightly higher rate. And so you could actually be able to negotiate with the landlord and get a little bit of money for that kind of stuff in exchange for higher lease payments or longer terms. Let me tell you a quick story before we wind up. So, when I was a business broker, I was approached by a bar owner who wanted to sell their bar, and I, packaged it up, evaluated it, presented it for sale. We found an interested buyer. The buyer came along, looked at the business, liked it, made an offer, went into due diligence, and then both parties together approached the landlord about changing the lease over. At which time the landlord said, "Oh, well, you need to bring me the deal, your financial statements, etc., because buried deep within your lease is a first right of refusal on any bona fide offered by the business." And the seller didn't really know this. He didn't remember because it had been like 20 years since he had signed the lease. So the seller had to bring the buyer's offer, all of his financial statements, et cetera, to the landlord, who then sat on them for a week and a half, analyzing whether he wanted to buy it or not. Because he had the right in the lease to just step in and do the deal if he wanted to. And ultimately, he didn't. And he did agree to an assignment of the lease to the buyer. And then, funny enough, it was a multi-unit property. The next time another unit became available in the strip mall, it was sort of a downtown building. The landlord opened his own bar, and I can't help but think it had to do with the fact that he was able to examine the financial statements of the one that was sold and saw what a great business it was. Anyway, if you have a story to tell about negotiations with a landlord, either as a buyer or a seller, please in the comments down below, tell us your story. Other people would love to hear it. And remember, if you are interested in buying a business, head over to businessbuyeradvantage.com. And I just updated my book that came out in 2016, 21 Stupid Things People Do When Trying to Buy a Business. If you'd like to get your hands on that, it is now available as a paperback over on Amazon. And I will be recording it over the holidays for a new audiobook version as well. It's a little bit expanded, significantly expanded from the original version. And with that, we'll say happy holidays and we'll talk to you soon.
So, how can you learn more about buying, selling, financing, and managing small and medium sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.